We've got a few minutes to go over this one. What's your first take?
Well, a very important backdrop for this is that the framework the Fed uses for evaluating whether they should be hiking or cutting is the Taylor rule. And the Taylor rule has on the right-hand side two variables, namely unemployment and inflation. And both these components, namely wage inflation and unemployment, are actually pointing in direction at least of the Fed staying on hold. Obviously, this is not enough for them to consider begin to hiking. But at the end of the day, the tailwinds to growth continues to be very strong. We have an AI and data center boom. We have strong defense spending. We have strong tailwinds also from the CHIPS Act, the Inflation Reduction Act. And we also still have relatively elevated stock price and home prices, all things that are supporting the U.S. consumer. And even before we then know what Trump will do and what he announced on the tax policy yesterday, if we do get lower taxes on Social Security, on overtime, on tips, other things, this would also be a tailwind to the outlook. So it's not clear at all that the Fed is done. And for now, I think it will be that they will be keeping them on hold. But the door is still open to hikes coming later this year.
Recent communication certainly suggests they'll be on hold. Implied in their outlook still, and their communication as well, is a bias to reduce interest rates. When you say there is a chance to hike, I understand from what we've heard from a lot of people on this programme, the bar to cut has got higher. But it's the bar to hike a whole lot higher. Just how low is that bar?
But think about it. Since the election, we have certainly seen animal spirits increase quite significantly. If you look at capex plans from the regional feds, they have all started to reaccelerate in the last 2 months. We've seen very strong improvements in a number of sentiment indicators, all pointing towards that there is still a chance that now there may be in the business sector in particular, the feeling that, well, maybe we should begin to hire more, maybe we should begin to spend more in terms of capex. So it is still true where we sit today. The bar is high because the expectation is that inflation will continue to come down. But inflation today is still roughly at around 3%. So we're not near the target. And the trend in the last few months on a year-over-year basis has been up. So if you take both inflation and the labor market, in particular the unemployment rate falling, and also wage growth as high as 4.1 on average hourly earnings, those are very important indicators for the Fed when they think about what they want to do.